Today we're talking to Martin Checketts from Mills Oakley Lawyers about some of the legal aspects of buying and selling a financial planning business.
An important part of any financial planning business sale is how the deferred element of the consideration will be dealt with. It's really common when selling a financial planning business for the purchaser to pay an amount up front and then to leave an amount at risk and paid perhaps 12 months after completion of the sale. And the reason for that is the buyer wants to see that the business is going to perform in a similar way after he's bought it than it performed beforehand. So he puts part of the price at risk, and that price may reduce if the revenues of the business don't translate for the buyer in the post-completion period. When drafting and negotiating these clauses relating to the deferred consideration, there are quite a few aspects that the parties need to take into account. Firstly, from the seller's perspective, it's really important to think about what security you should request from the buyer in respect of the payment of the deferred consideration. It's pretty standard in these deals to leave something on the table and to have an amount of the price deferred. But the flip side for the seller is that you really want to see that the buyer is giving you some security for payment of that deferred consideration. And that security could be, for example, a personal guarantee from the directors of the buyer company. It could be a second charge over the buyer's business behind the bank. Or it could be some other security, such as putting the deferred consideration into a retention account. There are a number of options, and there's often a reasonable amount of discussion and negotiation around the nature and extent of security that the buyer will provide for the deferred consideration.